Bandhan Mutual Fund presents MF Corner.
Hello, welcome to the special edition of MF Corner YouTube edition. Thank you so much for tuning in as always. Today, what we're going to be understanding is behavioral finance. What is behavioral finance? Why is it important for you as an investor? Connection with mutual funds. What should you be keeping an eye out on? Why is that the necessity for you when you are investing? To understand all of that today, we are joined by Harsh Kumar, co-founder and managing partner at Zvest Financial Services, LLP, joining in with us to talk to us about that. Thank you so much, Harsh, for joining in with us, because this is an interesting topic. I find it interesting. Why? Because it's not that many people talk about behavioral finance, but the importance of it is really key. So let's just start by the basics for our viewers to understand what is behavioral finance. Why is it different from traditional finance?
Hi, Vinnii. Thank you so much for having me here, and thank you to your viewers also for logging in. Now, most of us believe that behavioral finance is a very new subject. On the contrary, it's around 50 years old or so. But if I traces its roots, it's more than 100 years old. Now, what is behavioral finance? If I compare it with traditional finance assumes that human beings are rational economic men. Human beings take decisions very, very objectively. People plot things on Excel sheet and then they take the decision. But in reality, that doesn't happen. All of us have emotions. All of us have our own biases. We have greed. We have fear. And when we factor in all these things, human beings become very subjective in terms of decision making. And to capture that subjectivity of decision making, behavioral finance gained prominence. And over a period of time, we are seeing that behavioral finance is becoming more and more relevant, more and more important, because with the advent of social media, with the advent of technical trading, it's more relevant than what it was 20, 30, 40 years back.
Okay, surely emotions play an important part and has become more relevant now in this current scenario. How does all this actually come into play for maybe when you're comparing and talking about mutual funds? How do biases affect mutual fund investing? Particularly, maybe you say an SIP or lump sum. If you could give our viewers some bit of an example on that front as well.
Right, Winnie. So when it comes to SIP, the biases have little less role to play, but when it comes to lump sum, the biases are very, very prevalent. Now, let me take the lump sum part and try to explain it through that. Now, there are different biases which sometimes we understand, sometimes we don't understand, and those are our blind zones in which we operate. To give you certain examples, the first and the most important thing which comes to my mind is loss aversion bias. Now, what is loss aversion? Assume as an investor, you make 10% in a particular script. And on the other hand, you lose 10% in another script. Now, the joy of gaining 10% is much lesser than the sorrow of losing 10%. So this is called principle of loss aversion. Now, for an investor who's looking to invest lump sum, if he or she feels that market can go down 10% tomorrow or 10% in next 1 month or in next 1 year, he or she may not be able to take decision. There would be an inertia not to invest in the market. Second bias which comes into play when it's lump sum investment is anchoring bias. You would have seen a lot of your friends, investors saying that when Nifty comes down to 20,000, I would start investing. When this particular stock comes down to X level, I'll start investing. Now they have anchored that number in their mind, assuming that that number is the fair value of that index, and they would invest only at that level. Sometimes those levels come, sometimes those levels don't come, and the investors are waiting just to enter. Third is the status quo bias. Now, what is this? You have money lying in your bank account. You need to move money from your bank account to your mutual fund portfolio. You need to select which funds to invest in. This requires a lot of effort and hard work. Now, status quo doesn't let you move out of your comfort zone and invest that money. And at times we have seen people sitting on huge amount of money in their savings account, in the fixed deposit, waiting to enter the market, but they don't get time, they don't get energy or inertia to enter that. Last is herd mentality. Now, in lump sum investment, what happens when the market is good, when it has done well for last 6 months? I would even leverage and invest into the market. But on the other hand, when the market is down, when the market has been in a downward trajectory for last 6 months or 9 months, instead of looking at valuation and investing into the market, I would want to be a part of the herd, and I would say, look, market is not looking good. Let me not participate in that. So all these things start affecting an investment journey because these biases become prevalent in the journey. Now, what can be done? So, somebody, if is looking at SIP investing, the timing is not in the control. There is no anchoring bias which is involved. There is no status quo which is there. There's no herd mentality. So, as an investor, you are much better off automating the processes than trying to enter doing lump sum without objectively analyzing it.
Right. Uh, Harsh, you were talking some bit in terms of how investors get swayed, right? And it is very
Right.
common, right? Because you want to be a part of everything, that FOMO feeling that we talk about. You don't want to miss
Right.
out on things. And sometimes what investors do, and everyone does, is you look at more on the past performance or the hype that is there in the market for certain things and start investing on that basis. How
Right.
does this actually affect mutual fund returns in the long run, and why is it important for an investor to avoid such situations, and how can they avoid this mistake? Because it's very natural as a behavior to feel that fear of missing out.
Right. Now, I totally agree with you. And, we have seen that in last 3, 4 years when a market was doing relatively well, and if your neighbors were making money, you would get, tempted that why am I not making money? And there are ways to overcome that. Now, one of the first ways in which you should look at that approach where you say that I am not going to be in a FOMO zone, but I'll be in a zone where I am doing joy of investing and making my long-term wealth is having a clarity on what you want to do. So the first and the foremost thing which we say for our investors is that you should have a IPS. IPS is nothing but investment policy statement. It should capture what are the risks you want to take, what are the returns you are targeting, what is the liquidity need you have, what are the review mechanism that you want to have it in place. So that should be, so to say, your Bible, which you should refer to with respect to your investment journey. Now, IPS is not something which is very stagnant in nature. Now, you are single today, you get married tomorrow, and you have kids day after tomorrow, you change your jobs, you have aging parents, all those things play a role in that. And your IPS can be tweaked from time to time, depending on how the situation changes in your personal lifestyle. So that is the first step to do that. Now, once you have IPS, then you need to arrive at what should be the asset allocation mix. In simple terms, it should be how much debt, how much equity, how much gold should be a part of the portfolio. It's like, you're going for a la carte dinner and you decide what starters you want, what main course you want, what dessert you want. You don't want everything to be starters or everything to be dessert. You need to have a mix of everything. Third thing, you need to be clear about certain principles of investing. What are those principles? First and the foremost principle is diversification. Now, why diversification is important? Over period of time, what we have seen is that a moderate return over longer period of time generates much more wealth than intermittent period of supernormal returns. To give an example, somebody invests today, makes 20% in next 1 month, and then waits to enter the market again, seeing those things which he would have seen earlier, could keep on waiting to just to enter the market. But somebody who's in the market, somebody who's well diversified across the portfolio may not get 20% return in next 1 month, or maybe not even in next 2 months, but over next 10 to 20 years, that individual would end up making much healthier return than the first individual, barring a handful of investors in the world who can time the market really well, but you can count them on fingers. Third thing, you should be clear that it is time in the market which is more important than timing the market. Maybe you have missed the COVID rally. Maybe you didn't participate in the market in last 4 years, and now you're feeling the urge to participate. You should be very clear. If you have 10 years, 15 years, 20 years horizon, even today when you are entering into the market, you will end up making returns which would be inflation beating healthy real return. So don't be in that FOMO. Think that, okay, I have next 10 years to give and then enter the market. Lastly, to avoid FOMO, one more thing which you need to do is once you are invested, avoid checking your portfolio day in and day out. I'm not saying don't keep a track of your money. You should know where your money is invested. You should know the logic why is it invested there. And you should also know why something is doing well and why something is not doing well. But checking your portfolio 10 times a day would tempt you to take action because you are human being. When you say something doing so well that you have made returns which you would not have anticipated, you will feel the urge to book profit and go for a party. But on the other hand, if something has gone down against your narrative, again, you will have the urge to come out of that and go somewhere else. So do check your portfolio, but at predefined frequency. Rebalance your portfolio basis your life goals and not just what is going in the market, basis sentiments. So these are the kind of principle which you should keep in mind. If you do that, I think you would avoid FOMO and you would have a very healthy wealth creation journey in the long term.
Okay, absolutely. Time in the market is more important than timing the market. And,
Right.
just follow these principles to avoid making those behavioral, decisions that you may just take. That's the word coming in from Harsh. Goal-based investing, you were talking about that as well right now, Harsh.
Right.
How important is that? Right? Like, so can it be a short term goal also? And can all these principles work on that front as well? Maybe I have a near term goal. Is that something
Right.
possible for, behavioral finance to help you in that sort as well?
So, Vinny, I'll take a step back and I'll tell you what are the different ways of investing or different philosophies of investing. So, first is which a lot of seasoned and high net worth individual follow, which is I have a given risk. I can absorb a level of volatility. And in that risk and volatility level, what is the best return I can make? So that is called reaching your efficient frontier. So just to give an example, suppose you have 10,000 crores today. Then you don't have any goal which needs to be fulfilled unless you are setting up a company and you need money for that. That's a different matter. But most of the people at that level would not have any goals which remains to be fulfilled. Leave aside their generation, maybe for next 10 generations, they don't have any goals for which they need to plan. So there the idea is how do they reach efficient frontier and they maximize their return without overgoing on their risk or overboarding their risk. Second is a goal-based investing, which is more for retail investor, more for new investors, where they decide whatever their goal is and basis a goal they invest. Now you ask a very important question that how does goal-based investing help? So assume a scenario that I asked you to go for a walk from tomorrow or go to gym from tomorrow, go and diet from tomorrow. Not that I'm asking you, I mean, if somebody advises you to do that. Now there are two approaches. One is you start doing that mindlessly from day one. After day 7, you would have a fatigue. After day 14, you would not feel like doing it. And after day 21, maybe you will end up leaving it altogether. But on the other hand, if you have a goal that I want to participate in a state championship in so and so sport after 1 year or 2 years, then you have a goal in mind. You are tracking where you are reaching with respect to that goal. You are waking up early every morning, taking actions, eating proper food, taking proper nutrition. All these things come to your life because you have a goal linked to that. Similarly, investing, if you are without any goal and you are starting into the field of investing. Remember, I told you that seasoned investors are different. But if you're starting your investing journey and you don't have a goal, maybe the first step of saving money today and not consuming it today for your future benefit will not come naturally to you. So step one is to keep the goal. Now there are two kinds of goal. One is short term and one is long term. For long-term goal, there are different kind of asset classes. Like for long-term goal, you can have equities, you can have real estate, you can have commodities and all those things. But if you have short-term goals, for that also you have fixed income instrument. You have certain products which are suitable for 6 months investor, 1 year investor. You can look at those products, link your goal to that, and invest accordingly. What helps when you have goals is that you don't get into the biases of playing on recent news. You don't get into the biases of looking at your friends and taking action accordingly. Suppose your goal is that after 6 months you want to go for higher education and you're saving your money into a low duration or an ultra low duration fund for that. And if your friend is investing into cryptocurrencies, you will not be swayed away because you know that his or her objective is very different from yours. So having goals really help, and it's extremely, extremely important for a first time or a new investors because otherwise they can get distracted very early and very soon.
Right. Uh, Absolutely, goal is important, but I just feel like is the easiest way if you have too much emotions coming into play, then to just go for an SIP. Is that the best bet for someone who's just starting off to avoid any noise that is there in the market then?
Right. So I won't use the word best, but relatively much better. Now, why do I say that? It's not only about investing, but about everything in life. If things are automated, if things are process driven, and if things involve much lesser manual intervention, then those things end up being better. So you talk about, top five companies in the world, be it Apple, be it Nvidia, and if you ask them, they're very process driven entities. They are not running on the whims and fancies of what the top management decides. So automation helps you process orientation, helps you in making the investment process oriented and avoids manual intervention. And the moment manual intervention goes out of picture, the biases becomes very, very subdued. I'm not saying biases can't play a role there. I mean, even an SIP can be cancelled, even an SIP can be, terminated or withdrawn, but the inertia required for that is very, very high. So definitely it helps. What are the other benefits? When you are doing an SIP investing, you are not into the habit of timing the market. Like we discussed earlier, time in the market is more important. And why we say that? There are enough and more data points in US, in India, which indicate that if somebody would have missed 40, 45 days over a period of 40, 50 years, that individual would have ended up making much lower return than savings bank account. So imagine the kind of risk you have if you miss 40 days in a 40 years journey or 50 years journey. So what you need to do, you need to automate your process where you say that I will be invested and SIP would help me avoid the risk of timing the market. Second thing which helps with SIP is that procrastination doesn't come into picture. And it's not just about investing. Like I gave an example of
Right.
being fitness free. You want to go for a walk, it's not an easy
True.
thing. You need, to come out of that procrastination that I'll start from tomorrow. So there also SIP helps because there is no tomorrow. It is all automated. Third is you avoid herd mentality there. Fourth is that it maintains the focus on the portfolio's long-term journey. And lastly, I would say that SIP may not give you return which is above normal because by nature itself, SIP would give you mean trending returns. But over a longer period of time, you will realize that mean trending returns are far superior than somebody else who would try to generate above mean return,
True.
thereby either sitting out of the market perpetually or taking undue risk and losing on the principal. Because at the end of the day, a lot of people have lost money not by being in the market, but by waiting on the sidelines to enter the market. So all these things can be avoided by participating in the market through systematic investment route.
Okay, Harsh, thank you so much for joining with us on this show and explaining our viewers so nicely about behavioral finance. What is the importance there? How can they avoid, making mistakes through behavioral finance? It's a key of this. So thank you so much for that, Harsh. And thank you so much, viewers, for tuning in as well.
Bandhan Mutual Fund presents MF Corner.